So a lot of you guys send me Facebook messages and emails and ask me questions about investing, and I'm always very happy to help you answer those questions because it's what I love to do in my spare time. And every now and then I get a question where a person is really critically analyzing investing and asking questions that I think a lot of people may be afraid to ask. Questions that are really important to think out and make sure that you know the answer to them before you go ahead and invest. So I received an email like this, and I asked the person if I was able to use his email and the questions that he asked in the email as a part of this video, because I think it will provide a lot of value to you guys. And the core of the questions that he was asking really came down to, how does active investing compound your money over the long term? He sort of laid out a scenario where he invests a lump sum of money at a discounted price. So the price of the stock is at 50% to its fair value or its intrinsic value. And then he sells that lump sum of stock, those number of shares, when it exceeds its value. And he was sort of wondering, how does that compound your money when you're not acquiring more shares? So that's what I'm going to answer in today's video. And I hope that this provides some value. If you have any further questions, you can always send me an email, leave a comment on the YouTube videos is probably the best way to ask a quick question so that I can provide an answer that gives value to everyone. But to sort of start answering this question, we need to sort of talk about, how do businesses compound their cash flows? So this is where it really begins as an investor, inside the business that we're investing in. And the best way to think about businesses is as cash producing machines. So these are businesses where they have a collection of people, a collection of assets, factories, machinery, technology, and essentially this machine is producing cash. They're putting cash into it and they're producing more cash. And in really great businesses, what will happen is that they will have some profit. They'll have some excess cash left over after a particular year. After they have their revenues come in and they pay all their staff and they pay all their expenses, they have some extra cash lying around. And really great businesses will be able to find use for that cash. They will reinvest it back into the business. They'll buy more factories. They'll invest in more staff. They'll buy more assets. And as a result, in the next year, they will grow their cash flows. And really great businesses do this at a stable rate over the long term, or a growing rate. So the rate that we're looking at here is the return on invested capital, or return on capital, or return on investments. Essentially, we're just comparing how much cash they produce to how much they invest. And really great businesses can produce a large amount of cash, a high percentage, maybe it's 10%, and then they take that cash and put it back into the business and still produce 10%. So the best way I can explain this is with a quick example. So the example I have here is, we can imagine we have a great business that can consistently produce a 10% return on their investments over the long term. And they're able to produce this 10% return regardless of how much capital they put in. So what will happen, let's say in the first year, they invest $100 million. And on that $100 million investments in assets and that sort of thing, they produce back a 10% return. So they get back out $110 million. Then what they're going to do is they're going to reinvest that $110 million. And then in the next year, they again produce a 10% return on that. And a 10% return on $110 million is $11 million. So now they have $121 million worth of investments. And great businesses can consistently do this over the long term. And what that means is that their cash flows don't grow in a linear fashion. They don't grow in a straight line. They grow in an exponential fashion. So they start off slow, but as they compound, they start to shoot off. And that is what really great businesses are able to do. So the next logical question is, how did those internal cash flows come back to me as an investor? Because I don't own the whole company, so I can't access those profits directly. I can't just go into the company and, withdraw some cash. So how do we actually get access to those cash flows? And then how do they compound our cash flows, our investments? So the first way is pretty obvious, and that's through a dividend. So as businesses reinvest and they grow their profits, sometimes they have too much profit that they can't reinvest it effectively. So what they'll do with that extra cash is they'll pay it out directly to shareholders as a dividend. And the way that this sort of compounds over the long term is that if a company is a great company and is compounding the internal cash flows, then it's likely that they're going to see a compounding in the dividends that they pay out. So in that same 100 million example, let's say they're paying out 10% of their cash flows as a dividend. So in the first year, they're able to pay out $10 million to shareholders. In the second year, they're able to pay out $11 million. And in the third year, they're able to pay out $12.1 million to shareholders. So that is compounding. And that means that the dividend you receive isn't going to go up in a straight line. It's not going to stay flat. It's going to go up at an exponential rate. And then as the investor, you can take those cash flows and reinvest it back into businesses, whether that's the same business or you invest in other businesses that do the same thing. And over the long term, that will compound as well. And that's just one proportion of their earnings. So that's just one part is dividends. But what about all the cash flows that they keep within the business? Well, the way I see this and the way that the markets work is that the value of businesses over the long term is just how much cash they can produce. It's the cash producing ability. A business that can produce is a cash machine that can produce a lot of cash is going to be priced higher than one that produces a lot less cash. So in that way, if a business is compounding their internal cash flows, if they're going from 100 million to 110 million to 121 million, all the way up to 300, 400 million over 10 years, then those compounded effects of cash flows will also be compounding the value of the business. And the value of the business over the long term will be reflected in the stock price. So from the internal cash flows, they compound the value of the business, and that compounds the value of the stock price, so that your investment in the stock also compounds over the long term in terms of the stock price, as well as in terms of those dividends that are going to be compounding if the business is consistently reinvesting at a high rate. And then the second part of this question in the email was essentially about how do you go about investing in businesses? Do you just sort of invest a lump sum and then sell it when it gets overvalued? And he also mentioned that he was sort of consistently investing in index funds. So he would consistently contribute every month or every quarter to an index fund, and that way he's always acquiring more shares. And the exact same thing applies for individual businesses with one exception, and that is if the business is priced too high to offer a good return. So if a business is cheap, meaning, and when I say cheap or undervalued or anything like that, what I really mean is that I'm comparing the cash flows that a business can return to me to how much I'm paying. I'm just doing a comparison. If I put $1 into this business, am I going to get $4 back over the next 10 years in terms of dividends and in terms of the value and the stock price going up? And if the business is sort of at a price where the return is good, then I'm not just going to be lump sum investing. I'm going to be consistently adding to that investment. I'm going to be consistently adding while it's offering me a good return. And the only point at which I'm no longer adding to those investments is when they're not offering a good return. When I look at the stock and I say, well, if I invest $1 and it's going to return me $1.50 over the next 10 years, that's not good enough for me. I would rather hold on to my cash and look for other opportunities. And then what happens if it gets overvalued? Do I sell my entire position in a lump sum? No, that's not really what happens. Most of the time, I never really sell anything. I'm only ever selling if a company's stock gets outrageously expensive. If it's completely stupid to keep my money in that investment, meaning keeping my money in that investment, I'm going to be turning $1 into 50 cents over the next 10 years. If that's the case, then I don't want to hold that business anymore. It would be in my better interest to just hold on to cash or look for other investments. But for the most part, our estimations of what a company can do over the long term are exactly that. They're estimations. So when we're estimating a fair value or an intrinsic value, we might be underappreciating the potential of the business. So we don't want to let go of a great business just because it gets a little bit the return that we estimate is a little bit lower, because it turns out that the business might actually generate much more returns than we expect, and therefore it's better to hold on to it. So only in very extreme circumstances would I ever sell out of a stock that's a really great business. For the most part, I'm trying to acquire stock of a great business when it's cheap, and when it's not cheap, I'm looking for other opportunities, and if it gets really, really expensive, then I may consider selling some of it off and moving it into some other sort of assets. And just to sort of summarize this and give you a nice sort of foundational view of investing that you should have at your core if you're investing, you just need to think about businesses as cash machines and working out how much cash you can get out of them. And I think of businesses in the exact same way that a person would think about investing in an investment property. And sort of the parallel comparison that I think can be made between the property market and the stock market, investing in businesses, is if you were to go out and look at an investment property, you would often find that the investment property that has sort of a house that has 1960s interior, it's all worn down, that house in the same neighborhood might be rented out for lower rent, it might have less rental income, and it might be valued or cost less. The price of the business or the price of the property might be less than a similar property that has a house that's been all done up and nice and ready for tenants. So I'm looking for businesses that have that 1960s interior. And if you were to buy a property, you would buy that property and then you would spend some money and do some work managing that property and making it more sort of attractive for tenants. And then at the end of that sort of short period of managing the property and fixing it up, you can rent it out for more and the value of the property has gone up. So that's the exact same thing as what I'm doing with businesses, except the one difference with businesses is, well, there's two differences really. One of the differences is that we're not managing it. So we're relying on a management team to make the right decisions to fix up the business and make it produce more cash again, as it's going through a down sort of period, a negative period. We need management to come in there and fix it up. And the other difference is that business cash flows can grow at a much faster rate than rental income ever will. Rental income really doesn't grow that fast at all, whereas businesses can grow their cash flows very quickly. So that's sort of how I look at businesses, and it's how you should look at businesses. Find really great businesses, great management teams. They have an economic moat, some kind of advantage that gives you confidence that the business is going to be around over the long term. Wait for the short-term problem. Wait for something to affect their cash flows, rising costs. Something, maybe the tariffs have put a lot of businesses cheaper because some of their costs have gone up in the short term. Maybe there's something else going on in the industry or the economy that's affecting the business in the short term. And the stock price will naturally go down with that. You can buy in when it's low. You can, as long as you trust management to fix up that business and make it profitable or make it much more profitable again in the future, then that's going to happen. Cash flows will come in and the price of the business will go up. So I hope that kind of answered that question. Compounding, it happens internally within the business, and then it comes back to you in terms of the stock price compounding and dividends compounding. And ultimately, the picture of investing is comparing what we're going to get back to what we're paying. And that's something that a lot of people don't do at all. They just look at the business and they see it's a great business with great products, but they don't think about, or they don't analyze how much cash we can actually get out of it. And that is one of the most important parts of analysis. So I hope this video helped some of you guys. If you have any further questions, then feel free to let me know down in the comment section below. If you have a long, detailed question that you want me to answer, then you can feel free to send me an email or send me a Facebook message. But if you enjoyed this video and you want to see more, then the best thing you can do to show me is to hit the subscribe button, or leave a like or leave a comment down below. Anything like that helps me out a ton. But thanks everyone for joining us today, and I will see you guys in the next video.